Good morning, everyone. I appreciate the opportunity to talk with you this morning and see some old friends. Kurt, haven't seen you in a while. I noticed the comments earlier about housing being multifaceted and multidimensional.
I have it cranked in here. Sorry, Kirk, we're having a hard time hearing you.
Oh, all right.
We'll try to increase the volume on our end.
Put your microphone near the computer.
It's coming out through that. That's why it's coming out through the ceiling speakers.
I do have an alternate headset I could use if that's would be helpful.
That's better, Kirk. Thank you.
Oh, all righty. As I was saying, housing is definitely a multifaceted issue, and I hope to give you an alternative view, if we will, of how housing markets have behaved. And I'm looking at over the last 30 years, because I think that look over time gives you a sense of where we stand in context. Years ago, I had a professor who asked me not to use the word crisis. It seems that we are perpetually in a housing crisis, and if we're perpetually in a crisis, then the word crisis really ceases to have good meaning. But what we are is perpetually confronting housing problems. And certainly a crisis can be true in the short run, and the pandemic has created some of that problem. But what I will argue is that the vast majority of housing markets and households, we in fact do not have great housing affordability problems. In fact, they're relatively localized, and they are within various submarkets of within our larger metro markets. So while the argument is that most markets have produced enough units in most price ranges, but they cannot provide enough units to meet the needs of the low-income households. And that, I think, causes us to change the way we think about intervening in markets. Now, I realize this argument's a little hard to make coming off 2 years of a pandemic. That pandemic has interrupted new house production. We have all manner of income interruption that has created problems for folks. We've seen eviction moratoria. We've seen problems of people unable, greater default on mortgages, greater default on lease payments. So we've got problems out there. But what worries me is we have people, good people, with good arguments saying that we have a shortage of anywhere from 3.5 to 5 million units in America. And let me just tell you that while there's good arguments in what they're saying, I don't believe it's true for the vast majority. Like yourselves, I'm a Midwesterner. I'm here in the Kansas City area. I've spent much of last week looking at Wisconsin numbers so I could become somewhat familiar with the situations in your state. We do have a set of hot markets in the United States that have a shortage of units, and you know these markets. It's Boston, New York, Washington, Seattle, San Francisco, Los Angeles, San Diego, and I jokingly refer to them as the sexy seven. You know, we hear the popular press constantly giving us stories from these 7 markets, when in fact, just a little piece of trivia for you, there are just under 500 metropolitan markets in the United States. There are another 400 so-called micropolitan markets. They cross a broad spectrum. They don't make the news, but you and I live in that middle end of the market. it's entirely possible that there are large shortages in those super hot markets. But as a practical matter, I think what I hope to demonstrate to you today is that when we look at more commonly accepted definitions of how well our market's working, how do we define affordability, you'll find that in fact we are producing enough units to meet our population needs, to maintain a healthy inventory of vacant units. But in fact, what we have is an inability to produce units at prices needed by the lower end of the market. So let me shift to the PowerPoint here. That screen. Alrighty, somebody wave at me wildly if you're not. See, okay. Is it working?
Yep.
Okay, thank you, Kurt. Well, unfortunately, it doesn't seem to be progressing. There we go, finally. Let me suggest two very standard techniques for assessing market conditions. And the first is simply one of answering the question, is the supply adequate to meet the demands of population growth? When we have that, the only difficulties we run into then are one of pricing, which I'll talk about in a second. We can measure the adequacy of supply growth by simply monitoring vacancy levels. And I'll show you what Wisconsin numbers look like here. And the key question is whether the supply is growing adequately to meet the demands of population. And when I say growing, I'm going to be showing you net housing stock growth numbers. That's slightly different than saying the number of new units added. When the housing stock grows, it means units have been added by new construction, units have been added by conversion into housing, but they have been lost by conversion of units out of housing or by demolition. So we're talking the net of those four effects. The other piece that we want to look at then is if the market is meeting the population growth needs, to what extent are the prices of these units matching the income distribution of the population? And just so we don't have any surprises, what I'm arguing is that, as in the vast majority of markets in the United States, we're building more than enough units. Our problem is that the prices just flat out don't match the income distribution. And that's important because that leads us to some decisions on how we intervene. There is just something about Americans that we just think we can build our way out of all problems. And full disclosure, I'm a recovering developer myself. I started out in architecture, built a lot of housing, have worked in affordable housing and in a lot of areas. I've been an underwriter for housing finance. I actually have been with the low income housing tax credit program quite literally since its inception. I played a tiny role in creating that program. And sadly, I will tell you, I have become one of the greatest critics of the program because it is no longer matching our needs. And I'll show you that and show you why it's important for you in Wisconsin. At its most basic level, we only need to add units where we have a shortage of units. And our production programs do just that. What I find is that we seem to be prescribing the addition of units in an awful lot of markets where we don't need them. The alternative intervention is types of income transfers. If in fact we have an adequate stock, but we have weak demand, and we find we have that in most places, then in fact the intervention needs to be methods of things like providing for home buyers, low-income home buyers especially, forms of down payment assistance, forms of soft loans. For the renters, the standard intervention is what we all know now is the housing choice voucher. It is just simply much cheaper to help a household afford a unit that already exists in the market than it costs to build a unit for that household. Right, so that's the basic idea of it. Let me put this in some context. We'll show you now. Now, this is the United States. This is not Wisconsin, but I'll show you some Wisconsin numbers in a minute, and you'll get a sense of how closely Wisconsin parallels what's going on. This chart gives you the historical illustration of vacancy. The upper line, the solid blue line, is rental vacancy rates. The lower red line is homeowner rates. It's just a standard rule of thumb. What I've done here is calculated the 53-year average. We have data from 67 to 2020. And I was gutsy. I went ahead and included the 2020 numbers, but between you and me, folks, we're going to be putting asterisks beside all of the census 2020 numbers forever. The 2020 census is just plain flawed, and so we're going to have to be real careful about how we interpret those numbers. But I went ahead and included them here just to have it cover as many years as possible. If you look just crudely, what you'll notice, it starts at 67. So down here is the 70s, the 80s, the 90s. Here's 2000 to 2007, the bubble, the crash and the Great Recession, and then these last 10 years or so are supposed to be the recovery from that bubble. You'll notice on the rental side, we had very tight markets. They went out of the norm. This 53-year average is about 7.3%. So I'm going to define that as a normal vacancy rate. And just so we understand, there's a good bit of debate among economists as to whether that's a good number. From my underwriting days, I'll tell you, if a banker is asked to loan millions of dollars to build an apartment complex, you don't want to loan money to a market that's got north of 7% vacancy. That's considered a soft market to bankers. But if you look at the 53-year average, you will notice the last time we had vacancy rates down at the levels that the bankers enjoyed, that you will notice that Jimmy Carter was president. That shows you how long ago we've seen that level. But we had a huge increase in production of multifamily housing. That was what we now know as the Section 8 new construction, substantial rehab, or Section 8 project-based housing. That was this reduction in vacancy during this period. And then that moved our market back up into normal levels and was true for the housing bubble for homeowners as well as it was for renters. The vacancy shot up way high during the bubble to a very unhealthy level. And then we've been seeing a decline since then. All right, we drop down below to the homeowner numbers. You will notice there's not the wild fluctuations over the years that we saw in the rental markets until the housing bubble. What's so often forgotten about the housing bubble of 2000 to 2007, we all think about it in terms of what happened to prices because of the excessive amount of mortgage money that flowed into markets. But we also forget that it was a production bubble as well. The developers did exactly what they were taught to do. If you see prices going up, that's a market you want to get into. So they built lots and lots of stuff, pushing for the first time in 50 years, pushing the vacancy rates of owner-occupied housing well above 2%. And just so we're all clear, that's a relatively unhealthy level. You will notice then the Great Recession brought that down. So we had the development industry will tell you we had years of reducing production. What I'll show you is, in fact, while they reduced production, they didn't really reduce it enough. But what I want to draw your attention to is the vacancy rate. The most recent numbers we have are 2020. You will notice the rental market is still within a very normal range. And understand the pandemic was beginning during this number. Now, we don't really have its full effects, but what I hasten to point out to you is the vacancy numbers are probably biased in the wrong direction. The way the Census Bureau counts a unit as vacant, it's assumed to be occupied unless an enumerator can confirm that it is vacant. All right. So we had a shortened census. The enumerators were called back from the field too early because the Trump administration stopped the census. So in fact, these numbers are probably incorrect. The vacancy may be a little greater than is shown. Keep that in mind because it's going to be important in terms of our understanding of what's going on. What I've done here is given you now a look at the 72 counties of Wisconsin. It got to be a little too difficult to run all the cities of Wisconsin, and I think so. I opted for the 72 counties. I think it gives you a better sense of it. But what we have is a range of vacancy rates going down here from an ultra tight 1%, this is the rental vacancy rate, to a high of 12.5, 13 plus up here. This is an open-ended one. If your market is normal, it would be in this 5, 6, 7 range. All right. So what you have is a set of markets that are way too high, a set of markets that are quite normal, but a set of markets that are fairly tight. So I again try to remind everybody that we hear the news and we hear about the shortages, but what I want to point out is most counties in Wisconsin have normal to soft housing market conditions. It may be a little understated. In other words, some of these might be moved over. My argument for a lot of these, and it's a hard one, we're never going to know who's right and who's wrong in this. I think we are looking at a short-term transitory problem in terms of some of these vacancy rates. And understand that is a controversial thing. We've got people out there, as I said, saying that we're short 3.5 to 5 million units. And just so we understand, in terms of the United States normal production, that's anywhere from 2 to 4 years of normal production that we're short. So we've got some markets in Wisconsin that are fairly tight. I don't think those are going to come as any surprise to you where they are. They are places like St. Croix, which is effectively the exurbs of the fast-growing Twin Cities, Ozaukee, north side of Milwaukee, and of course, Dane County with Madison. Those shortages, I'm going to suggest to you, are probably not because the industry is unable to produce the units. It has the capacity. What we have to be looking at is the availability of land to build the units. What I'll show you in a minute is that Wisconsin, like literally every other state in the union, has an enormous amount of industrial capacity. When there are shortages, it isn't because the industry can't build or doesn't have the capacity to build. It doesn't have the sites and or the financing to build it. All right. So I would suggest to you on the rental side, we don't have great tightness. However, on the owner side, we do. Now this one is tricky because this is where the markets have been most effective. If we had normal conditions, we would see relatively few markets over here in the red category. Most would be in the beige. When you see any counties up here in these levels, then these are the counties you worry about. And I checked, and there, again, no great surprise, these are the counties in the northern part of the state that are suffering from low or no population growth. Some are even realizing population decline. I'm on the Kansas side of Kansas City, so I'm painfully aware of the problems here in Kansas, as I often remind folks when I talk to them. Every time somebody leaves a Kansas county, they don't take their home with them. We've got an awful lot of homes sitting out there empty, and that's usually what's causing these high vacancy rates. What we have down here are very high vacancy rates, but remember that in any given year, most people don't sell their homes. A small percentage of people sell their homes. So you have a certain number of existing homes that come for sale, a certain number of new units that come on the market, and the new units make up a very significant portion of those. When the new units drop to close to zip, which is a lot of what's happening, then in fact, you've had a very significant withdrawal from units available for sale. That's what is driving an awful lot of that. All right, so what I would suggest to you is that the industry has the capacity to build. We just are seeing a short-term movement away from it. So let me switch now. I hope you can read this. I know it's an awful lot of numbers on the table, but let me describe it to you. And for what it's worth, these slides are in your packet. I'll be happy to talk with anybody about it if they want to go further, but it simply looks at 5 different time periods, 90 to 2000, which is a period of income growth and great stability in our housing market. 2000 to 2007 was the housing bubble. 2000 to 2012 was the bursting of the bubble and its crash. And then 2012 to 2020 is the recovery. So what we're looking for, and this is for all of Wisconsin, but population growth, household formation, and sorry, typo there, housing units. So remember, this is the net growth in housing units, which is new construction and conversion, net of demolition and conversion out of housing. So we should always see the growth in units match the growth in population. If we see the rate of households forming going beyond the population growth, then that means more and smaller households are forming, which tells you you've got adequate housing. If in fact you see the household formation rate falling below population growth, then it means the population or the stock is not growing fast enough. Oops, sorry. Drop down to these numbers down at the bottom. In an ideal world, the ratio of growth in units to growth in households would be about 1.3 to 1.5%. If you add 100 households to your population, you want to, build 100 housing units plus 3 to 5 more to provide for those households, to provide an adequate inventory of vacancy. What happened in Wisconsin is parallel to the nation. You had very balanced growth during the 90s. Look what happened during the bubble. For every 100 new households formed in the state of Wisconsin, you built 151 units, which is to say the industry built half again more housing than we needed. That created an enormous surplus. Part of what I'm arguing today, and have been arguing around the country, is that in fact, we are still suffering the problems of that overbuild. The industry argues, yeah, but Kirk, we cut back on our construction, so it's no longer a problem. And I'm afraid the numbers don't show that to be true. because even during the crash, household formation fell enormously. Housing production did not fall commensurately. So in fact, what we had is a continued addition. For every 100 new households formed during that crash period, we still were building 139 units. We have only had a reduction in the last few years. So we still have an excessive inventory to burn off in that. All right, so let me, with that, actually I wanted to point out one additional one, that one line that shows us this big problem of the surplus. When you have vacant units in a market, some are going to be for rent, some are going to be for sale. You're going to get a few oddball other things, you know, being held for seasonal housing and so forth. But we have this so-called other off-market category. These are units in probate, units that are, you know, being held because they were inherited. You know, little old lady passed away and the kids are trying to decide what to do. Units are in foreclosure, units that are waiting for renovation. Let me go just quickly so you understand. If you look at the numbers down here, you can see 20 to 30,000 units in the state of Wisconsin. Not an insignificant number, but that's normal. Look at what happened after the production bubble of 2000 to 2007. The numbers went up to 68 to 70,000 units. That's just way too much. So you've got not only too many units for rent, you've got too many of these other units. To give you a scale to that, I did a calculation of the surplus vacant units, the units you would not expect in a healthy market. In Wisconsin, that's 82,000 units. That's enough to house 184,000 people. Again, to give scale of that, you could burn down Kenosha and Racine tomorrow night. You have enough housing units in Wisconsin to house all the households in those two cities. I have a little difficulty thinking about a shortage of housing when the surplus stock is that large. All right. So with that in mind, let me shift briefly to a way for you to think about the pricing fit. And this is where I contend we have a problem. Not a shortage of units, but a bad fit with the price. We're looking at the value of homeowner homes, or this chart will look at owner-occupied homes, but it will compare it with the incomes of the households. What you have here is, along the horizontal axis, a set of income categories. The bottom four are the extremely low income. This is basically the poverty level is about between the fourth and the fifth. So we've got the households below 20,000 income, then we have 20 to 25, 25 to 30, so forth, and then the open-ended category up at the top with 150,000. So you can see effectively a normally distributed population peaking at around the 100,000 category. If in fact we have a well-disciplined market, when we take the units affordable to each of these households under current down payment, current market terms, we should see roughly the same number of units beside each of these numbers of households. Where you have more units than households, you really don't have much of an affordability problem. Where you have lesser units, that's where you have affordability problems. So now if you look at it, you'll see where the problems lie. Down here at the bottom end, we constantly are lamenting the difficulty of affording housing for low-income people, but in fact, it's not because of a shortage of units. The units are out there. Look at the other extreme. You will notice a whole lot of rich people decide to live in a house that is, shall we say, less than what they could afford. My wife and I are in that category. What the heck, we like house, but so what happens, a lot of the households in these upper reaches live further down, but you will notice in the middle range, 125 to 250, you've got, in fact, a very comfortable surplus, but most of those units are consumed by the higher income household. But if you look at that price matchup, every value category below $250,000, in fact, is in surplus. When we look at the rental markets, we'll see it's a very different picture. If you look closely, the blue bars indicate the renter distribution. And if you look closely, you can see two different distributions. A fairly normal distribution of renter households. They're a little poor, with peaking at 50,000 a year in income. But you have a second distribution of the poor. You will notice for every category of rent below $500, the rents that are affordable to the poor, every one of those categories is in shortage. When a lot of the housing advocates say we have a shortage of housing, what they're saying is we have too few units priced sufficiently low to help those folks. But look at the middle ranges. You will notice the rent categories of $625 to $1,250 are in significant surplus. In fact, our rental units are glutted in the middle. All right. Why is that? Because that's the sweet spot where development is feasible. The luxury market is not as strong in rentals. So in fact, they tend to build in the middle. Why does this become a problem for us? Because this is where the low-income housing tax credit program is adding units. So our primary production program is adding units in markets that are already saturated. All right, so what does that mean to us? Well, the conditions of our markets are such that the vacancy rates are low. I suggest to you the problem is transitory, that production has generally exceeded needs, but our particular needs are such that we've got in Wisconsin an enviable affordability issue. You really don't have an enormous one on the homeowner side. It's spot shortages, but the need is acute among the poor. So what I suggest to you is, as you think about ways to intervene in housing needs in Wisconsin, keep in mind that you need to ask yourself, am I looking at a Dane County with a shortage, or am I looking at the rest of the counties where in fact we have adequate supply and the appropriate method for us to intervene is a voucher? And I think there is some hope in this. You guys all being housing people, we're all watching the movement in Washington. Like a lot of housing folks, I applauded the Biden administration when for the first time in my adult life, where we began to find people talking about some sort of universal rental assistance. Now, that was briefly talked about, and then it got scaled down some for the Build Back Better. It at this point now has been pulled out of the Build Back Better plan, but the administration's proposal is a significant increase in the voucher program. But here's the scary one that I want you to think about. It appears to be in jeopardy in Washington. The program proposals that seem to be making it through committees is to significantly expand the low-income housing tax credit program and then to create a new parallel neighborhood tax credit program. If these were both used well, I would support them enormously. We have a need to renovate that older existing property, those 70, 80,000 surplus units that are sitting there off the market. Watch out for the development community though, because they will always follow the path of greatest profitability. And that means they like to build new low-income housing tax credit units. And again, if you're not in a tight market, rarely is that the appropriate answer. All right. So with that shocking news, I'll get off my soapbox and turn it over to Kurt. I think you were next.